Market open. Now, we've been talking in great detail about the real estate rally, at least the real estate rally that we're seeing in the stock prices. Now, look at this. The Nifty Realty Index in the last 1 year has risen 97%. In the last 3 months, about 48%. And in the last 1 week, about 8%. 6% of that came just on the day of Thursday. This is being pushed, and this is, of course, being fueled by a lot of on-ground data that is showing an appetite for real estate. Does that bear out, and can we see sustainability in the space? To speak on this, I'm joined today by Parikshit Kandpal. He's VP Institutional Research at HDFC Securities and tracks the space closely. Gulam Zia is joining us. He's Senior ED at Knight Frank, that has been putting out some of that data and showing the kind of boom that we've seen in the space. We'll also be joined by Irfan Razack, the CMD of Prestige Group, and speaking to him in a bit on where he sees the opportunities coming. Welcome to all of you, and thank you so much for speaking with us here on NDTV Profit. Gulam, I'm going to begin with the H2 data that Knight Frank put out, and I would say that in a sense led to the latest rise in real estate stocks, although it's been a consistent story, to be honest. Now, you're saying that you've seen the highest ever sales volumes in H2 2023 calendar year in the last 10 years, where total housing sales have increased 5% in 2023. Now, the point that struck me is you're still seeing 60% of the sales coming just from 3 regions, Mumbai, NCR and Bengaluru. Isn't that going to limit your upside beyond a point?
That's true. That's true. But then I would want to also say that the other markets are also not doing that bad. And that said, now the other markets like, say, Hyderabad, Chennai and Kolkata, etc., are waiting in the wings. So while the Mumbais and the Bangalores and Punes have been doing well, even the NCRs have been catching up. So if it is just 2 or 3 markets that you're talking about, which has contributed about 60% to the overall volume of about 330,000 apartments sold in the top 8 cities, I would say it is not really something which will restrict the run in the future. So other markets are all there. Like NCR, I would want to also focus on. It has done fabulously well, while Gurgaon is the one which is doing well. But then Noida, Faridabad, then Ghaziabad, etc. are also picking up. So overall, the numbers that we are talking about, 2023, the overall number of 330,000 apartments sold, it's something which will be, I would say, in 24, not showing any signs of slowing down.
You know, I just want to get that on-ground view from Irfan Razack as well, CMD of Prestige Group. Mr. Razack, great to have you on NDTV Profit. Thank you for speaking with us. Now, Bangalore has been, I would say, the red-hot market, focused on the luxury segment. Can you give us some color on what has changed specifically, and do you see enough sustained appetite for luxury apartments in Bangalore?
Good morning. I believe that apart from the luxury, because luxury is always a niche market, it depends on what we defined as luxury. Maybe we can call it premium. People are looking for larger homes. And that is a function of what happened during COVID. People needed an additional space working from home. But having said that, I always believe that there is the sweet spot is always in the mid-income housing, and that will keep growing, while the premium and luxury also has caught up well. And I don't see any letting up, and I believe the demand will be quite sustained. And any new product in a good location from a good builder will always have a demand.
Absolutely. You know, we also have a point of view coming in from DLF. Mr. Razack, stay on with us. Mr. Kandpal, also stay on with us. You know, what we're seeing is that this is not only a story of 1 or 2 markets. For example, DLF's Privana South in Gurugram has seen record sales for over 7,200 crores ahead of its official launch. 25% of those sales are coming in from NRIs, and a booking amount of 50 lakh rupees is being seen versus 10 lakh rupee industrial standard. I have Akash Ori, Joint Managing Director and Chief Business Officer, DLF, joining me on this. Akash, very good morning to you. Let me take that question to you, which I just asked Irfan Razack. Is it all about luxury? Is it all about high-end?
No, I thank you. Thank you for having me on the show. I think what has happened right now is what I'm seeing over the last year or two is that the residential real estate has become a priority. And what people are doing today are moving onto better and bigger homes. They are looking at better developers. They are looking at secure investments. But most importantly, I think the trend is changing towards, you live once, let's kind of live it king size. And therefore, whichever category you may be in, you are looking at bigger and better homes. That being said, the other thing is that real estate is in the DNA of every Indian. I have maintained that for a long time now. You really can't take it out. I mean, the money was taken into other asset classes, but I think with the regulations and the business that is now being kind of in a certain way regulated with all norms, the confidence of the NRIs and confidence of other businesses, investors is now back. And they are looking at, and in fact, the point that you just made, 50 lakh rupees as against the norm of 5-10 lakh rupees, no bulk booking, single one investment or one home to be given to one family. All this leads to just one point that, look, today the investor is looking at better and looking at homes that they can move into, as an option. So I think that is something that is today more prevalent than just mere speculation.
Rory, stay with us. We'll try and understand more about what's happening with DLF and in the real estate sector, since we've very opportunistically got you on the call this morning. Mr. Razack, I want to come back to you. This is Samina from NDTV Profit. And I want to understand, because I've heard a few of your interviews in the last couple of months, and you've indicated that it is the affordable housing segment. Projects you started off thinking would be affordable have actually now become slightly more premium. And the cause of that really is the cost of land and the cost of construction. Both those things have gone up. And of course, we've also seen a few reports where they've said that price hike has not been very sharp. It's anywhere in the range of 7 to 8%. Mr. Razack, help me understand this. What happens to margins in such a case where your cost of production in that sense goes up? Do you have the ability to pass on that cost increase to your customers or your end consumers? And if yes, to what extent? Does better sales also mean better revenues, which also means better margins, or not really?
Now, while we are looking for better sales, better top line, we also have to make sure that we protect the bottom line.
Yeah.
I am not saying that since the market is booming, since sales are happening, a developer should irrationally increase the price, and then that will be shooting yourself in the feet. As long as you're able to balance your margins properly, offer up good product at a reasonable price, I think the top line sales will keep happening. And of course, the bottom line will be protected. Finally, we have a commitment to our shareholders and stakeholders to see that we also deliver good results. So it's a balance that we have to keep doing. And while we're doing what we are doing, we have to keep an eye on both. We have to see the acceptability for the consumer, as well as see that the company also has a decent margin at the bottom. Of course, having said all that, if you look at the past few years, PAT margins of all listed developers are all in single digit. Maybe if that increases, it could increase by a percentage point, a couple of percentage points, not more than that, since now it's all about how to work efficiently.
Okay. So fair expectation. I think we would see a little bit of improvement in margins, given that revenues have clearly been stellar for the real estate sector. Akash, comment on that one. This project sold out in 72 hours from the official launch. How has pricing been for this project? Has it been better than what you've seen in your last projects? Has it come at a discount? Give me a sense of that, because I think while we're so focused on the top line, bottom line is critical to be protected, especially when you're a shareholder looking at what to do with these stocks, right?
Yeah, absolutely. I'll second what Mr. Razack said. I think margins are very critical for DLF. We've not been in the rat race of launches and products unless margins are protected. Also very important that it has to be affordable for the customer. You don't get carried away by the opportunity to make more money. you are always making sure that there is enough money on the table for the customer, and it has to be an inclusive growth model. So that is what we're also known for, and I think that drives us more than anything else. So with respect to this particular project, let me assure you there have been no discounts. In fact, it has already been pegged at a premium from what the markets there are. But that's a larger ecosystem that's being built. So therefore, it's the beginning of a lot of things. So that's a different story. But yes, margins are the main thing that even guide us. So we'd like to stick to that.
Right. Parikshit Kandpal, VP Institutional Research, HDFC Securities as well joins in. Parikshit, how are you approaching this space? I know the markets are very excited because there have been record numbers, inventories have dropped, affordable segment is looking good. Of course, luxury may not be doing as well as most of us would have liked, but nevertheless, give me a sense of what do you do in terms of stocks? Are you buying stocks because of their geographical focus in the realty pack, or is it more market cap focused? Is it more valuations focused? Is it more bottom line focused now at least?
So what we have seen is that over the last few quarters, clearly a lot of investors have missed out on this rally. So what people are looking right now is that companies which can grow or outperform. So the most, wherever we see good growth pockets, so investors are looking at those kind of stocks. Obviously the stocks have run up, so there is very concerns around the valuation. But what I believe is that as the volume numbers have grown, almost doubled for some of the players, as well as pricing has gone up by 30-40% for some of the players. So there will be strong cash flow generation over the next few years. We are also seeing that in our DCF valuation, companies which had huge land banks, and we used to say that it's a 40-year land bank. So now because of this acceleration in volumes and pricing, so we see that compressing to 20 years. So that brings a lot of valuation upfronting. So that is also helping and aiding companies with strong land banks. So we will see the capital values or the valuations of these companies with strong land banks going up in the near future. So a lot of excitement around the stocks. Investors are having a fresh relook. Some of them are having this FOMO feeling, but my sense is that the cycle is here to stay for another 2-3 years at least.
How do you pick in a market like this, Parikshit? Hi, Tamanna here. You're right. There is definitely a FOMO feeling, but what are you looking at when you see these companies? And, you know, we're lucky we're having a great chat where we have two key players on the panel today talking about how they are approaching the business. But what are the parameters that you are looking at? And in terms of valuations, are you still satisfied that there is enough upside?
Yeah, so upside can be built in the sector. So as I said, the growth has been there has been outperformance on growth. So obviously, even we are surprised the kind of growth which is happening in the sector. So when I look at the stock picking, so clearly we are looking at more aggressive players who have been expanding outside their core markets, so newer markets. So growth will come from there. Secondly, the mixed-use players where we have seen built out of new commercial portfolio or mall portfolio or hospitality portfolio. So those kind of players been seeing renewed interest because they have a balanced portfolio of both residential and rentals. So those players are benefiting. So third thing is we also look at cash flows. So where the players which are able to extract a much higher market premium on their pricing. So we have seen some players getting that intangible benefit of higher pricing coming in. So they will outperform on their cash flows. So we look at market cap to cash flows or EV to cash flows, and we see which developers are trading at lower valuations, and we see reasonable upside for those players. So these are some of the factors we look at.
What do you like, Parikshit, if I were to push you for the companies that you like in this space right now where you see a further upside?
So we have been quite positive for almost a year. We have published our top picks. So Prestige is there, Shobha is there. We like Brigade. So the South pack we like a lot. Within the Northern pack we like DLF, and in Southern pack we like. Sorry, in the Western India, we like Oberoi, Phoenix. So these were some of the names we have been putting out as our top buys over the last few quarters.
Okay. I want to just come to Irfan Razack for an outlook of what you're seeing. Now, you have already successful projects which are on. Give us a sense of pipeline, Mr. Razack. And do you see inventory levels and the supply-demand sort of mismatch that we have right now maybe disappearing in the next couple of years? Because you did see a bit of this coming from a post-pandemic outlook by developers who wanted to take it a little slow, take it a little easy. Now you have that mismatch. Do you see that mismatch sort of disappearing?
Yeah, I mean, that's the good news. Basically, inventory has disappeared off the shelves. Wherever projects we had launched, and like now you talked about DLF, they launched a project, they're sold out. It's a similar case we have at our company. And we need to have a very strong pipeline. And that's why we are working all the time, every time, to make sure that whichever geography we are working in, that there's enough inventory that comes in. Because whenever we are launching a product, it gets sold out or near sold out. So the problem is what next? So the approval process has to be good. You have to have your raw material in terms of land, and then convert that into a project and get the approvals, get the RERA number, launch it. It's a huge amount of work that goes in, and we definitely have to have some projects which are number movers. While recently we did a huge launch in Hyderabad, the Prestige City Hyderabad, which has met a very good response. It's 8,000 crore top line revenue, and out of that, we've almost sold half. So that's what is helping us to spur the growth, and that's what is making things happen. And we have to, in every geography we work in, whether it's Bangalore, whether it's Hyderabad or Chennai or Mumbai, we have to see that we keep getting more and more inventory, because there's no old inventory on the shelf. And that's, I think, a good news. And that's good news for almost all the developers who have been doing work on a very professional manner.
Absolutely. Gulam, I just wanted to get a take from you on what is happening with affordable housing. Is affordable housing now no longer the most, I would say, lucrative space for developers? What are people doing who want houses? And, we were speaking to DLF, who said that Indians have real estate in their blood, and they've realized you have only one life, but you also have only one pocket. So what is happening to the affordable housing segment? Or are you going to see that upside coming in the premium luxury segment? Or have those definitions also changed?
Well, a lot of things have happened in the meanwhile, Tamanna. Many of those who would have bought affordable housing because of wealth creations and moving up the ladder have been buying better homes. So that's one part of it, because of wealth creation that has happened. But affordable housing segment itself has been shrinking alarmingly. What used to be almost a two-thirds of overall sales, say about 7-8 years back, and about more than 50% 3 years back, has shrunk to just about 30% last year. Last year, prior to that, it was about 33%. So it has actually been a free fall as far as the overall share of affordable housing in the larger pie is concerned. And that remains a concern, because the mid to upper end will have a limitation. How much of sales would you continue to do in times to come? Ignoring affordable housing is a big, big question. So here it is. Last year, about a couple of months back, we did hear about Finance Ministry talking about a big corpus to come in as a incentive for the lower end of the market, to give them 200 to 250 to 300 bips on their home loan interest rates. If that is coming in, which actually a lot of people have been talking about it, the moment that comes in, we do see a big reason for the lower end also to start expanding, because whatever said and done, the biggest concern for them, because they are the worst hit due to the increased home loan interest rates. So if that respite comes in, we would see affordable housing also coming back on track. So while mid and upper end has been doing fabulously well, we need to worry about the lower end. And that one kicker that comes in will get that also back in the market. And you're absolutely right. The developers are not too keen to look at affordable housing because the margins are not as good over there. With the volumes changing, with the velocity of sales shooting up, I am sure even that will change, and that will give much needed boost to the real estate industry altogether.
Right. So Razack, I have a couple of things that I want to talk to you about, and I want to understand from you. You did indicate that a large chunk of your sales are coming in from new launches. Do you currently have any inventory, old inventory, that you're sitting on?
No, that's what I said. We have got the shelves empty as far as the old inventory is concerned. So it's always that we have to be quick, we have to be alert, and we have to produce more new launches, see that the approvals come in and bring in the new launches. Otherwise, we really don't have any inventory to sell.
In terms of timeline, so I know approvals do take a while to come through, acquiring the land, procuring land, approvals, license. I mean, there are a whole bunch of things that go into this. And construction activity is not like a manufacturing unit where because demand goes up, sales immediately come and, support the demand. How long is the cycle? And also, I want to understand, you have Hyderabad, you've got a couple of projects on marine lines. I was passing by my house yesterday on Pali Hill. You've got a beautiful project called Prestige Daffodils. It's, in fact, a neighboring building. So very exciting stuff happening. But in terms of timeline, from the time you procure land to the time a project comes on board, what is the timeline for that?
Yeah, I mean, if you have to work aggressively, it takes about a year to bring from the time you procure land or finalize a piece of land to bring it into the market. So less than that, I don't think anybody can do it unless it's something really quick happens. But then from then onwards to produce that and then make that into a building and to see it's habitable, that's another 3 to 4 years. So believe you me, it's a gestation period from the time you finalize the land to convert that into a product which is inhabited is almost 4 to 5 years. So that's how it works. And fortunately for us, you said real estate is not manufacturing, but we have sort of mastered that art to see that as soon as we have got the approvals, we get the contractors on board, and the technology is also helping. And that's helping us to see that we produce better and faster. Actually, it can't be just faster, it has to be better and faster, and ultimately deliver to the customer to their delight.
Razack, we're running out of time, but one very quick question, and I want to talk about your commercial and your mall as well. I know you made that large chunk sale to Blackstone, and things have sort of got better since then. There's also been new regulation change where micro REITs are now going to be, hitting the market soon. And with yields expected to improve on the commercial side, any plans to have a REIT, to have an IPO? I'm just trying to understand how the commercial aspect of this versus residential plays out for Prestige.
I mean, see, fortunately, as a company, we have got all asset classes. We are pretty big on commercial, and we are building a complete new portfolio on the retail mall side. Out of the new portfolio, 3 are already trading. And 10 more are under various stages. Some are under construction, some are under planning. So hopefully in the next 3 to 4 years, we'll have another large portfolio. Yes, I mean, to exit and to sort of raise finance is always an option. And there are various options for it. And I must tell you, we are also quite large in hospitality. So hospitality is also a big segment of our portfolio. And even there, we have many assets which are trading and many under construction. So it's a balance that we have to keep doing, because CapEx projects definitely take up a lot of capital, and we have to make sure that this capital has a balance of equity and debt. It can't be only equity and it can't be only debt.
Absolutely. So the big takeaway from this extensive chat is that the real estate story is very much on. The trajectory continues, and perhaps it's just the start. Thank you so much to all of you for joining us on this special conversation. We're taking a very short break, but when we get into that break, just take a look while we do at this exclusive story and this exclusive conversation with Vivek Lohia, MD of Jupiter Wagons, stock which is definitely on the up move. My colleague Harsh had a chat with him.
As you rightly said, that the government of India is very aggressive in terms of its wagon procurement plan, and I think the direction of the government is very clear. They want railway to be a significant contributor towards the GDP growth of the country and to regain its rightful share in the logistics space. That will not only help the profitability of railways, but overall the carbon footprint of the country and reduce the logistics costs. Yes, as you pointed out, we are aggressively looking at capacity expansion. I think before the end of this financial year, now we are looking to produce close to about 1,000 wagons a month. So we will continue to be aggressive when it comes to government tenders. and we would like to maintain our market share. And now the future tenders which are coming is basically towards supplies in FY26 onwards, because more or less now the tenders which have come out have covered FY25. So we'll continue to build on our order book. And besides that, the private sector demand is still very buoyant, and we continue to add orders every month. So I think when it comes to the wagon space, for us, it's more about execution, bringing in new designs and improving our quality.
Right. I'd just like to make a quick clarification from you. 1,000 wagons per month by the end of this financial year. Have I got that right?
Yes, that is what we are looking at.
Sure. That's a fairly healthy clip. Also, with regard to the current orders, you've won roughly 2,000 odd crore of orders since the end of Q2. Are most of these, the large chunk of it is Government of India, but is that largely margin accretive for you? When I've done the math, roughly it looks margin accretive.
It is, definitely it is. As we move forward, one is definitely with size, you get a lot of economies of scale. And plus, we are working significantly towards our backward integration and improving, becoming much more cost effective by bringing in new technology. So it is not only about bidding at higher margins, but also more about being much more cost effective and being in terms of quality, delivering a much better product.
Sure, I understand. And this 8,000 crore order book that you currently hold, would you say that execution would be by FY25 close? Is that how you would target execution?
So no, it'll be FY25, and some of it will spill over to FY26 also. And I've also mentioned that this year we believe that we'll be adding significant further order books. So in terms of visibility, we don't see any challenge. I think there is significant visibility in the sector. For at least till FY27, we see a significant visibility. Plus, Railways recently opened a global tender where you need to make, again, it's a new design wagon which they will be procuring, and the supplies needs to be done over the next 4 years. So it is, I think for us, our focus is more on our backward integration and in terms of the execution.
Right, I'll come. Sure, sorry, apologies, please complete.
Yeah. No, I think, so for us, where we are looking at margins more is from the point of view of being much more efficient. I think because, again, there is no point burdening the nation with, higher prices. Definitely, as the order books improve, your margins do improve, but where we want to differentiate ourselves from the others is that through being much more cost efficient. That is our focus.